Hello traders, it's Samurai Trader here. Welcome to my training video, Exit Strategies and Profit Targets. Many of us of course know of Kenny Rogers, the great singer, and I love his song The Gambler, and at times I think it was almost made for traders. I really do. And to quote a couple of the lines out of it, because I just think it just relates so well to trading. You've got to know when to hold them, know when to fold them, know when to walk away, and know when to run. And for those experienced traders, just realize just how true is that statement. It really is. So this lesson is being prepared particularly for my students of my main course, my day traders course. I've had many of my students come to me at times with various questions, and what I'll do is I'll turn it into a training session, which is what I'm doing here. So if you're new to my YouTube channel, or if you haven't already purchased my course, please drop me an email. I'll send you information on it. I now have students in over 22 countries around the world that use my day trading strategies. Most of you have watched me trade live, have attended a webinar or even a live seminar that I've run or conducted, and you know my passion is day trading. I love trading. I live for it, and I live for the research and development that goes with it. So if you want what I consider to be the world's best day traders program for under $200, which I virtually give it away, it's now over 10 hours of online recorded instruction, and I give email support. Please drop me an email and I'll send you some information, and let's get you on board as one of my students. So moving on from the advertisement, so let's get into it. So if you haven't already done so, please go to full screen, because I am very shortly going to go to some live charts. Now of course, one thing that I do in every video, and I have to by law, is just mention the risk, of course, in trading. Whether you're trading stocks, futures, or forex, there's always risks associated with it. And if you haven't read this statement, please just put a hold on the video and read this statement. Now I just want to cover this off, and I like to give a lesson in every video and I like to cover a lot of information in my videos. I want to try to give you just incredible value when you watch my videos, not only for the money if you've already bought my course, but also for the time that you invest. You can always get more money, but you can't get more time. That's something that the great Jim Rohn once said, and I've always loved that. So you know what I want to do, I want to cut down on the time it takes you to successfully learn how to day trade and to swing trade, because as you've heard me talk about time and time again, you need to join the 5% club. If you're not in the top 5%, you are going to lose. You're going to lose your capital. That's the reality of trading, is that you have to be in the top 5%. And actually next week for a client, I'm actually putting together a research report on the latest statistics from the CFTC on the amount of and it's based upon US statistics on live accounts, unprofitable accounts, etc., and the various brokers. I've got a very interesting report I'm putting together, and I may actually even do a video on it, and it just further highlights you've got to join the 5% club. So why are traders losing their money? Of course, lack of knowledge, which is something that we all know, and I'll skip through this quickly, otherwise the video will go for 2 hours. No trading plan, poorly defined exit strategy, which is what we're going to be talking specifically about today, a lack of confidence, and that is why you have a trading plan. That is why you keep your daily diary. One of the first things I do, traders, by the way, I can tell by whether or not you keep whether you have a trading plan and whether you keep a daily diary, a trading logbook, on whether you're going to make it. I do not know of any successful traders that do not keep a trading diary. I'm serious. They log everything. They keep statistics, and you hear me talk about this regularly. The best traders are pilots. They're used to referring to a flight plan, pre-post, so pre-flight and post-flight. They'll write everything down. If there are any problems with the aircraft, you know, they put all of this down, and it's so applicable when it comes to trading. Lack of self-discipline. The more we develop our habits, the more we develop self-trust, the more we develop self-discipline. Discipline is a muscle. The more often you use it, the stronger you get at it, and it's just so important. Then of course, poor money management, risk, and it comes down to, because you may have a really small account to start with, well, don't start live trading until you've got enough capital, because if you start by risking 5 to 10% in every trade and you have a number of losses, not only does it destroy your account, but you are destroying yourself mentally, your self-trust, psychological damage you cause, and it's just so important. Now I want to relate now to my trading, because many of you have watched my videos or have watched or been trained by me, know that I am a certain type of trader. That is, I'm more of a scalper. I'm in and out. Now my target has always been, the last 4 or 5 years, $200 to $300 a day per contract. I'm now increasing that, where I'm now targeting $400 a day per contract, and I'm going to discuss a little bit how I'm doing that, because the exit strategies are so important to that, because I've got the high probability setups. What I'm now going to do is to maximize those. Now the point I want to say here is, I really believe in CANI. Tony Robbins talks about CANI, which is CANI, which stands for constant and never-ending improvement. That's what trading is about for me, is becoming one of the world's best and getting better each and every day. And that's my objective for you, is to have and to achieve incredible success. But my style of trading may not totally suit your style of trading. That is, I'm more of a scalper. Now in a lot of my videos I've quoted that I'm after 11 ticks or after 12 or 13 ticks, smaller profit targets. And I'm going to cover that in a moment, why that is, because it's the way of a scalper. Now when it comes to exit strategies, there are literally dozens of different ideas on exit strategies. I don't have all the answers, traders. I can only present what has worked for me the last 24 years, what has not worked, and what I've found in research. But I don't have all the answers. Now you may have a strategy that suits your personality and works really well for you, so please stick with that. If you're not sure, once again, go back and back test it over 100 trades. It's got to be a minimum of 100 trades, and you've got to be very cautious of something that we call curve fitting, which is something we're very cautious of when we're doing our research and development on trading systems. That is, you've got to go back and you've got to have a really decent size of statistical information to make what we call an informed decision. Now getting back to this, is this ancient Buddhist proverb is, the road is smooth, why do you throw rocks before you? Now for me, what that says to me personally is, why complicate things? So my exits are very simple. Okay, so usually I'll have fixed targets because I'm more of a scalper. That's what scalpers do. I trade lower time frames, and the lower the time frame that you trade, the quicker you need to be able to move. For an example, in moving your stops, if you've got a trailing stop, it's very hard to do at times. Now action will remove the doubt that theory cannot solve. That is, we can all read a book, for an example, on how to swim, but there's a huge difference between reading a book on how to swim and actually swimming. The same with flying an aircraft. You know, you can read all you like about rotating the aircraft at so many knots and leaving the runway, but of course unless you actually have flown an aircraft, it's totally different. So in the end, action will remove the doubt. Now what is great, of course, that with the simulators on modern charting software today and trading domes, is that you can simulate 100% basically with the good platforms of what you would get in real life trading. So you need to develop that first, but you've got to take action. Now confusion is the doorway to a new understanding. If you are a new trader, and I know from my experienced traders, you hear me talk about this all the time, is you need to be patient, and you will have your aha experiences. And if you get confused by some of the things I say, please go back and re-watch it, write it down, maybe Google it, but it'll sink in after a period of time. So let me give you some tips first of all. Okay, first, the first rule of exits, you've got to have a risk reward of 1-to-1 or better. Now let me say something here. There will be times when I'll take a trade for maybe only 7 ticks, but my risk has been maybe 12 or 14 ticks. Now I can't remember if I mentioned this. Everything I'm going to show you today and talk about is applicable for all markets and all time frames. I'm going to be concentrating on, and only one chart. I'm just going to show you the NQ133 tick chart from today's trading action. It's Saturday morning in my part of the world, so it was Friday in the US, because it really doesn't matter where you are in the world or what market. These exit strategies and the setups work on all markets, all time frames, providing you have some volatility. So getting back to this, there will be times when I will go to scalp maybe only 7 or 8 ticks, but my risk was 11 ticks. It's because I'm about to hit a major area of support or resistance or a pivot level. But from my trading experience, it is worth me taking that risk. But it's rare, traders. You won't see me do it very often. I might do it once every couple of days. I'll get in for a quick scalp, but I'm ready to exit that trade. Blink of an eye, I'm out of there. But if you don't have a risk reward of 1-to-1 or better, unless you're a really good scalper, I'm not saying that you can't make money, because there are professional traders that do. They're scalping and they've got a wider stop for an emergency stop. It's what they do. However, for most of us, we need to have a minimum risk reward of 1-to-1. In other words, if my risk is 12 ticks, say on the NQ, which is $60, I need to have a gain of a minimum of 12 to 13 ticks, and I'll usually try to stack an extra tick in there. A tick on the NQ is $5, because what that does, it covers my brokerage. So where my minimum daily goal is $200 a day net per contract, I trade multiple contracts, but you always break it down. What's my target per contract? I like to move away. What's my overall target of 2,000 or 3,000, 4,000 a day? I try to move away from the overall money scene. I don't want to clog my head up with money. I want to talk about ticks and a small amount. I just feel better about that myself. So, and I don't mean to be raving or rambling on this video, by the way. I want to get a lot of things in. So my daily target is $200 a day per contract, which is 4 by 11 ticks. Now 11 ticks on the NQ, as we can see just down here, traders, is $55 less the brokerage of $5, okay, or your commissions. So it comes down to $50. So 4 net scalps a day, and I'm up 200. And yes, of course I have losses, but I've got very high probability trading strategies. Now my target personally, as I mentioned earlier, is I want to really improve that, and I'm going to talk to you about a couple of things quickly on how you can do that. Is, for an example, 2 21 tick trades, which is $105 on the NQ after brokerage, 100. I've achieved the same outcome, half for trading, half the trades I need to take. Commissions do have a big impact, so that's why you need to really look at the commissions that you're paying. Now if you're trading futures, you should be paying no more than $5, between $4 and $5 per contract. It drops down on your volume. So where I'm down in the low 4s now, and I can get better deals, but I'm quite happy to stay where I am right now with the broker. So on Forex, you may be paying 2 pips, which on a full contract is $20. Up to 4 ticks, that's 40. Commissions can have a big impact if you're a scalper. So the next thing I wanted to bring up was divergence trades. When you're trading against the trend, it's like trying to catch a falling knife. The metaphor I use there is that you need to have a target, a minimum of 2-to-1, because your win-loss ratio, it's not going to be anywhere near as good as trading with the trend. You're going to do better trend trading. Once again, if you jump into a fast flowing river, do you try to swim across the river, up the river, or do you go with the flow? of course, when you're trading, you want to go with the flow. You want to go with the river itself. Now, the other thing to look at is what's the anchor chart telling me. Now, because if you look at a higher time frame, and I work on a time frame of approximately 3 times higher, right, you want to go with that flow of the overall trend, because that then gives me an idea is if I'm going to go with the flow, it means I can generally achieve a higher profit return on that trade. The next comment I've got there, am I in wave 1, 2, or 3? Now the market moves in waves. Now I'm not going to talk about Elliott waves and all that sort of thing. That's a bit beyond me. I like to keep things simple. But one thing you'll see is when you get in a trend, you'll have pullbacks and retracements. At least generally, 2, 3, 4, or 5 before the trend ends, or it may change market conditions, or it may change at least for a short period of time. It's because if you get into a new trend in wave 1 or 2, the opportunity for you to scalp or to achieve a higher profit target is much more realistic in wave 1 or 2, because you've got a lot further to go in that trend. So you really want to keep a note of when you've got a new trade, or a new trend I should say, is that how many trades are you into it. And I'll show you some examples now. And actually I should just say that, how do you define a trend? Well, if you're using a MACD for an example, are you above the 0 line? If you're above the 0 line on your MACD, it generally gives you an idea that you should be long, or the market overall could be the long side. If you're under your 0 line on the MACD, it could be telling you quite possibly you should be considering short trades. Is my 0 lag or your Hull or your 8 EMA above your 34 EMA? Is the 34 above the 89? Is the 89 above the 200? Because if you've got all of your short to medium moving averages all in an uptrend, all above each other, it gives you an idea that the market is trending. What's my volume like for the day? If I have a low volume day, quite possibly I'm going to be in a trading range or in areas of consolidation. Where I've got great volume, generally speaking, I tend to find that you'll get some great trends. So I want to know what my volume for the day is. The other thing there, of course, is pivots, pivot points, floor pivots. If you're above the primary pivot, good chance that you're in an uptrend. If you're below the primary pivot, good chance, of course, you're in a downtrend. And that's all relevant to how many ticks or how many pips or points you can squeeze out of a trade. Because if you're in a great strong trendy market and you get into that trend, you're going to have some great opportunities to really maximize your returns out of that trade, or out of the trades. Now when I'm going to hit areas of support or resistance, you'll hear me talk about front running. Now front running is if I know I'm about to hit a floor pivot, say in R1, and so I'm heading up to that, I will quite often have my target 1 or 2 ticks or pips below that pivot, so I'm out before the crowd. Because quite often you'll go up there and you'll turn just before it, or you'll hit it and you'll turn. It's strong resistance or support areas, so I'll front run. So these are all considerations for your risk reward area. Now most trading platforms give you multiple options for targets today, and even with your trailing stops, with many of the good trading domes and software packages, you can actually trail your stops in the dome. You can have it in there, and we're going to talk about that in a moment. But this brings up a really important thing. If you're seriously considering day trading or do day trade part-time leading to full-time, make sure you've got a great charting package and a great trading dome. Very important is it's you can't win a race with a three-legged horse. Okay, you've got to, because it's your key tool. Your charting package, your trading dome are really critical, very important, and you learn how to use them. Once again, we do that through our sim trading. Now why isn't that, sorry, just there we go, just want to make sure it's not rolling over. There we go. Okay, so ratchet your stop with the trade, high returns overall. In other words, if you've got trailing stops. Now, one of the challenges I've got with trailing stops and the way I trade is that I want movement. I want momentum, and sometimes the market moves when I'm trading the 133 tick, or if I'm trading of an evening, the 89 tick on the NQ, and even the Euro Stoxx 50. The market at times can be moving that quickly that it's very hard to manually ratchet your stop up or down, but overall you will make more money. But to now, the way I trade, I don't actively trial my stops, but I've got some great traders that do very successfully. So if you don't have time to adjust your stops manually, perhaps you need to increase the time frame that you're working with. The other thing on your profit targets, of course, you're going to test swing highs and lows, and a high of a day, low of a day. Now I have this rule. If, say for an example, if my target might be, just say 14 ticks, and if I go up and hit 12 ticks, I'll move my stop to break even, or at least plus 1 or 2, depends where I am in the market. If I believe I'm heading towards the end of a trend, such as I'm getting divergence on my indicators, and let me quickly mention this: if you're getting divergence, say on your MACD or on your platinum, or maybe if you're using RSI, whatever indicators you like to use, if you can see you're getting a lot of divergence on your indicator, or you've got good divergence there, be ready to exit the market, because there's a good chance that you're going to quickly turn. So consider that. So you want to be looking for divergence. So you're going to have these different tests. So what is the day's trading bias, long or short? As mentioned earlier, that's really important, because when you get into a trend early, you're going to be able to maximize your profits. Now I'm going to quickly run through these on the screen, then I'm going to flip over to the chart and I'll show you some of these live on the chart, which is the best example. So using a fixed target, as you know, that has been and still is at the moment is my main form of setting my exit strategies, because it works for me, because I'm a scalper. I don't have big profit targets per trade. I like to get in, get out, all right, because my trading entries are a very high probability. But I also know that once I get into those, after 4 or 5 candles of candles moving in the same direction, and just go mark this up on virtually any chart, when you have candles 3 to 5 to 6 candles in a trend direction and you get a pullback, you'll generally get a pullback. And that's the point that I wanted to also mention, that say if your target's 14 ticks, you're up 12, and you move your stop to break even plus 1 or 2, the amount of times it will come back, stop you out, then continue it happens all the time. It can be really frustrating. So this is where you got to be very careful on how tight you bring your trade up after you get in towards your profit target, because it comes down to really getting to know your market. Because remember, every market's different. They've all got their own personalities. So let me say that again. So if you had a 14 tick target, you've gone up to plus 12, you go to break even plus 2 ticks, the market comes back, stops you out at plus 2 ticks, and then it goes on and hits your target. That gets very frustrating. So just something to keep in mind and for you to have a look at, to back test your strategy on your market and your time frame. So a fixed target also is a great confidence builder. That is, if you're trading only one contract, or maybe two, or you're new to trading, providing you've got the one-to-one, it can be good because it's developing, you're getting some wins under your belt. It works really well. Number 2 is a trailing stop. That is to be trailing a stop 2 candles below, and below those 2 candles you want to be at least 1 tick or slightly below. We'll have a look at that on the chart in a moment. Taking profits at areas of support and resistance, which we'll have a look at live on the screen. And if we look at both 3, 4 and 5, all these are basically the same. They're all areas of support resistance. Is that this is where you may be considering having your profit target set a couple of ticks below those areas or above, and also being ready to set your, or to getting set up to exit the trade should you be hitting those major areas. If you're getting some resistance, there'll be time and time again you'll punch straight through them, continue in a strong trend, but it's not unusual to get those bounces. Another exit strategy is using what we call measured moves, and I'm going to show you that on the chart. I really should have put 0.6 measured moves and Fibonacci extensions together, because as you'll see in a moment, they work really well together. The market tends to move in waves, as I mentioned, and it's early in a trend. Your first 1 or 2 trades, measured moves is a great way of maximizing your returns. Now, standard error bands, I'm going to be doing a lot more work on standard error bands for exits, because I think there's big potential there, and I'll probably do a video for my students over the next few weeks on trading standard error bands for exits. I think there's big potential, and I'll show you that in a moment. Divergence and angulation. When you're trading, you're starting to get divergence and angulation away from price. My students know what angulation is. Get ready to exit. You want to really bring your stops up and consider sitting out and waiting till at least you get the next pullback. Some of the other mechanical ways are 3 lower closes. So if you're long, you have 3 lower closes exiting a trade, or 3 higher closes if you're short. The next one, point 10, is using the 8 EMA, which we'll have a look at on the chart as we move along. We've got trendline exits. I used fractal points for my students. Should be well aware of how we do that, drawing trend lines fractal to fractal. Point 12 is counter trend T1 signals. Now, a T1 signal is formed, and let me just use, say if we're trading with the trend, is where we have two high closes, and the third candle opens up and ticks above those 2 candles. We then get a paint bar. Likewise for the counter trend T1 signals plot automatically, and I'll show you that on my TradeStation in a moment. And so you get a counter trend signal T1 that also is a signal to potentially trade. In actual fact, John Carter, who made this technique quite famous, we've changed the codings a little different on these ones, but he will trade a with trend T1 signal to the counter trend T1 signal, and I'll show you that. Heikin-Ashi candles, I'll put that on the charts. That's another great way of staying in trades. Now, getting back, I'm showing you a lot of techniques, and just once again to throw this in, I'm mainly a fixed target trader because of my form of trading. You've got Fibonacci projections and extensions, which I'll show you in a moment. Time stops. Now, a time stop for me is when you're in a trade for maybe 15 minutes, it's not going anywhere. Remember, time as a scalper or as a day trader is not normally on your side. We are momentum traders. We want to jump in a fast moving river. Okay, we want to go for that kayak ride. So it's really important for us is that if you're in a trade for a certain period of time and it's stalling, that's usually ringing alarm bells for me. Okay, so you want to consider exiting. There's a ton of indicators you can buy out there for stops, such as an ATR stop. So there's lots of different tools out there that you can purchase, which may help you with your stops. Once again, the more decisions or the more things you do in this area, the more complicated it becomes, the more confusing. Remember, we suffer from information overload. We can only process 5 to 7 pieces of information. So the more things we've got on a chart, or more things we're trying to do, the more complicated it becomes. So I just wanted to show you before we go to the live chart a Fibonacci extension. Now, most good charting packages now have Fibonacci extensions. The tool is under your Fibonacci tools, and likewise I mentioned standard error bands before. Most good charting packages now have that in there as a standard indicator. So to draw that, we're going to go from point 1 to point 2, then we can go down to point 3, and what it does, it measures point 1 to 2 and projects from point 3 onwards. and it can be a great way of projecting. Now, as trade is the way I trade with ticks and with range, the market moves that quickly. And in a way, this is exactly what a measured move is. A measured move is where we are early in a trend, we're in a new trend, we measure point 1 to 2 and we project point 1 to 2 from point 3. That's all a measured move is. But out of here, where normally we might have been out up here, so you're taking this measured move early in the trend, and because once again, you after wave 2, well, after really I should really say wave 3, it's going to start to really taper off, and there's a good chance you're heading towards a correction, just the way the market moves. So measure move point 1 to 2, and we project it from point 3, virtually what a Fibonacci retracement tool is going to do for us. Now let's now go and have a look at some charts. And for this one, I mentioned earlier, I'm using the NQ133 tick chart. Now it doesn't matter what you're using, what market you're trading. What you will find, of course, that generally speaking, if you say trading a 5-minute candle, you can have a lot of price movement. And this is why I love tick and range charts and volume charts, is that you tend to have a smoother price action. But without turning this into a charting, what type of charts I use, I've already done videos on that. One advantage with minutes is that you know exactly when that candle's going to close, and so for setting up a trade, etc., there are some benefits. But anyway, horses for courses. So let's have a look at this. So if I move along here, let's just go back. This is now today is Saturday the 18th in my part of the world of July. So it's 10:13 where I am now. So this is taking yesterday's price action. So it's still in LA, and even in New York it's still Friday afternoon, Friday evening now. So if we have a look at some of these trades we've got here, one of the things you're going to look at for am I with the trend, and I mentioned earlier, is, and let me just remove this. I'm not going to talk about all our different trade setups. You can find out about that in our course, but you can see here we've got the yellow line here. I will tell you is a 34 EMA, so it's going to give me an idea where the trend is. I've got a 200 EMA here, I've got an 89 EMA, and we've got a 34 again, and then we've got our zero lag. So it's going to tell me a lot about where the market's moving. So where I've got these directional trades, or I've got everything's in an uptrend, you're going to be able to squeeze a lot out of a market. Now for an example, we had a classic, it's basically a T10 entry right there, and let's just say we got in here, closed at 1150. If we rode it up to about here, 1150 high of 20, where you've got what's that, that's 6, that's 5, that's 20 ticks, 21 ticks in that move. Half of your day's profit there. But we were early in this major pullback and trend. Okay, so the earlier you are in a trend, the more likely you are to get these great moves. Now what I'm going to do here is I just want to see where the pivot is. Okay, now here's one of our floor pivots, an upper pivot. And what is that one? Which one is that? Sorry, I'm just going to have a look. Just I won't bother, we'll spend too much time going backwards and forwards. We can see here we're heading up to a pivot. Now as far as profit targets go, you'll see this time and time again where you'll go down, you'll come down, and you'll go from pivot to pivot. So as a profit target early, particularly earlier in a trend, you can see we go up and we nearly hit that pivot. So you could have squeezed out, there's a good 40-50 ticks in that move. So you can see that you can do really well out of those. Now where I would get anxious, I really don't like going in a move and getting a major pullback. That's why I like to scalp. Okay, I would have made money out of all of those moves. Now I can't tell you how I did out of those because it was before I was trading last night, but these are all great 11-15 tick moves. Now our stop of course is going to be 2 ticks below here, here, here. So we're scalping out on all of these. However, if you want to squeeze more out of a trade, you've got to be prepared for these pullbacks. and that's one of the disadvantages, of course, is going for a higher profit target. Now let's have a look at this as far as then goes support. The 89, we all know, will bounce off the 89 time and time again, and this is where I might even go for a lower profit target, because sorry about that moving up there, here we are here, because my 89 is down here, and in fact I would be front running or have my target, my first lot of contracts, off at least at the 89. It's the way I trade. Now because we've got a good come off, we're really coming down here. Down the bottom here we can see our long-term stochastic is basically a T2 formation, and my price is starting to close below the 34. You may be able to go for more. That is, you may be willing to say, okay, I want my 15-20 ticks out of that. I like to respect these areas of support resistance. That is my trading style. Now down here we got great divergence on our on price here, and bang, up it went. Yeah, now if we go and have a look for that pivot, we can see we're below the pivot. So you could have either your target for up there or for T1 plotting. Now let's have a look at that. The T1 is this little paint bar. See that paint bar there, there, that is nothing more than a candle formation. So once you understand what that candle formation is, you can be prepared for those T1s. So John Carter, he likes to ride these out, enter down here, and he will exit on his T1. What that does though, he had an entry just here and he wouldn't have been out till here. So you get these great moves of 20, 30, 40 pips at times, because you're trading T1 to T1. So for those of my students that have got my course, something for you to strongly consider and do your figures on. If we look at this move here, T1 entry, T1 exit. Okay, so you can really pick some pips up there. Now with all of these, and here's a classic T10. We've got another one here. So for my students, where you've got a T10 entry, what does a T1 signify? Usually a change in trend. So you're going to be able to squeeze more out. Now if you take this classic T1 just here, and of course that didn't plot till there, just let me get here, close 1875 high. There's a good it's good 24 ticks in that move. So you may have it down for your T10 entries that you have a higher profit target on your T10s. Here we can say, all right, we've come down into downtrend, we've now bounced off our 200 classic 200 bounce, we're in a new trend. So what am I going to have earlier? One trade, two trades, and by the way, even if you, and which you wouldn't have hit your profit target in this one, you were still fine because you didn't tick below 2 ticks below here, and up it goes, and there you romp your 20 odd ticks in coming up here. Now I will mention this while we're at it, and sometimes I'm hesitant, traders, in talking to new traders about this, because it will become confusing. You also need to be aware of time of day turns. That is, you will find time and time again certain times of a day the market will turn. It's not uncommon for around 12:15 my time, bit after midnight, that we see these moves. So the market's been open 45 minutes, it'll go up and you'll get these bounces, and you see this nearly every day. So as you gain experience, and maybe write this down in your notebook, hopefully you're taking notes as I'm chatting here, that time or time of day turns you'll see time and time again. They don't always happen exactly at the same time, but it can just make you more aware. Now if there is something else I want you to be aware of, is that when you are well out of your 34, and let me go and put our channel on here, traders. When I've got my channel on there, and you can see here our price action is well out of the channel. The further out of the channel you are, the more likely you're heading to a pullback. Now it doesn't necessarily mean a change in trend, but at least a pullback and then a trend continuation. So see here, we pull back a little bit. Here we're well out of the channel. Now if we look down here, I mentioned you want to keep an eye on divergence. Now this is only a few percent out of 100 towards whether you should exit the trade, because this happens a lot and the market keeps moving. You just got to be really aware of this, but just keep an eye on what you've got. There is, we've got a great T2 entry, we can see it here, perfect T2, but look how far out of the channel we are. You ideally want to be towards, or at least in the channel. Remember when our T69 trade is, we've just broken out either on or in the channel. See here, we're getting well out of the channel here, and if you look at that, that's a good 8 ticks. Okay, that's at least 8 tick move just all that one candle alone. Then we go up, we've got divergence, and we see we get a reversal, then of course it falls away. And what have we got over here? We've got a perfect T10, long-term stoke down, curl up, roll over, T10. Now so T10s, you've got a good, what have we got over here? We've got you can't see the figures on this side, but we've got 2 4 6 8. What's 4 8s, traders? It's very, as I mentioned, it's late morning here. I've been up since the wee hours, so we're getting close to, what's that, 30 ticks or so, 32 ticks movement just in that move there. It's a T10, sorry. So you may wish to write down your first 1 or 2 trades in a new trend, go for maybe 20-21 ticks. Your T10s go for a good 2 to 1, 20 odd ticks, because you'll see this time, look at this T10 over here, see how then bang, all right, perfect T10, great trade, perfect T10, great trade. So you just got to be aware of that. Now what about this T10 just here? You can see you've actually got a T10 setting up. Well, it's not a great one. We've just started to break down. Okay, also, right, so you might have been faked in to that trade. You might have. You can remember, when you're trading live, it's very, very different, and you actually had a lot of divergence, so you might have been in that one. Once again, the whole thing of going for a 2 to 1 on your divergence trades. Now T10, just as a reminder, is a change in trend. It's almost a counter trend trade, almost. You've just got more evidence that the market is turning, so go for a higher profit target. Now what we've got down here is a beautiful T89. T89s usually signal a change in trend and a higher profit target. So what have we got happening for your profit exits here? Well, so your entry, if you waited for your zero leg, was not till this candle here. So your first target, or for your total target, would have been, where's your logical one? I would have been aiming for the pivot. Okay, your 200 is still in a good uptrend. You've got a great T89. Traders, a T89 is just one of our counter trend trades, very just a really good one. If you I don't want to say cherry pick, but if you wait for your best ones, they're very high probability and great returns. And look at that there. Right, so a great trade. And the other thing too is, you need to be developing patience with a lot of these, because you're going to get your little pullbacks, and this is where you can get anxious. So we can see here we've got some beautiful T2s, T2, it's a little bit whippy. Look at the size of your candles. Just one thing as a reminder, traders, when you get great big candles and you've got to put your stop 2 ticks under, quite often we're breaking our money management rules. That is, our stop's going to be too big. Remember, there's another trade just around the corner. How many trades have we had so far? There's probably been a good dozen of them so far, so just be patient. You had a little T1 right here, which is a T. Sorry traders, you probably can't tell, it's winter here in Australia and I've got a bit of a cold and I keep having coughing fits, so I just gave myself a 10-minute break from recording and I can't remember where I was up to. So anyway, so sorry if there's a gap in what we're just talking about. So anyway, I think we're talking about pivots, trading from pivot to pivot. So please watch my pivot video where I cover this in a little more detail. So we can see here that we're just also talking about the further out of a channel we are. So I'm just going to go along here, and here's something else I notice is that when you get your 89 bounces, they can quite often be a really good trade as well. So you can have a higher profit target. Now here's an example down here of, I mentioned to be careful of divergence. You can see we have divergence, we had a beautiful double top, and counter trend trades, divergence trades, you can go for your 2 to 1, your T10s and your divergence trades, because you're a change in trend direction. If they're going to come off, they're going to do well. So here's what else I want to show you, a way of recognizing change in trend. So let me disable this for you. Now I'm going to mark these up. Let me just do this, and I nearly forgot to mention this. When you see your zero lag, your 8 EMA, or your hull cutting through the 34, see it there? Now note this here, okay, all the way down to here. Let's go here. Okay, we're above, so longs only. Now it's a little choppy, we're going through lunchtime, and remembering also traders, this is Friday afternoon your time, so you get a lot more chop. So you're still above. Okay, change, you go above, nice trade. You can see here you basically stayed above, and away it goes. So generally speaking, on most trading days, just want to be careful Fridays, when you see your 8 cut through, or your hull, or if you've got a zero lag, cut through your 34, it's a good indication of a possible change in trend. And the reason I bring that up, when you're looking for T1s, when you're looking for your wave 1s, wave 2s, they can just give you an idea. Now notice here that we're still in an uptrend, and here in this case we were trading above the primary pivot, which gave us an indication that we'll possibly go to the long side. Now a couple other things I want to mention. I've already mentioned here trading T1 signals to T1, there to there, exit, okay, with the trend. Now I wanted to show you this standard error bands. Now I will probably, and I'm yet to do a whole lot more research now, and let me say this, I get regularly traders will say to me, why don't I use this indicator, why don't I use that indicator? Well, there are literally dozens of indicators, traders. I use what works for me. And remember, the more we put on our chart, the more information overload we are likely to get. So let me put this on. Oops, I should do it correctly. Let's get this down here, standard error bands over to here. Now standard error bands are very different to Keltner or any other sort of bands you may have traded. Okay, so the principle here in staying with the trade is up here. For an example, we had a T7 trade, a counter trend T7 double top along with the T10 and divergence. Okay, so just a great trade. Now see the bands here. Your exit would not have been until you cross the band. So see how we're on the outer band all the way down here. Now with two higher closes, you may have decided to exit there even earlier, but you'll see that, and if we look on this other side, if you use the standard error bands, you had an entry, sorry for flicking this around here, you had an entry down here. This was a classic 89 bounce and a T2, so it's all the signals. You've got your 34 in an uptrend, your 89, you've got your 200. Now you could have stayed in this trade all the way up to here. The rule is you stay in a trade, and I will point out with the standard error band, the stronger the trend, the narrower the bands become. So see this here, how they become very, very narrow, and you would exit on the close over or on the lower band. You had an entry here once again as a bounce, and we had numerous signals right here. You stay in that. You can see here it's narrowing. That's a signal to stay in there, and you would have got out there. Now let me go back. I won't be rushing out to use this strategy. I've already got something that works, and as I say in most of my videos, if you're already using something that works, don't change it. Look at and ask yourself the question, how can I improve what I'm doing? Very, very important. That just comes back to information overload, or constantly looking for the next holy grail. Is that you know, there are dozens of strategies that work. It's the psychology part. Now let's have a look at a band trade here. We had a 89 bounce right here. We've come down, we've hit our 89, so it's one of our classic 89 bounces, and you would have stayed in this trade all the way up. See, you're traveling up, you're up, you're up, and it's not till here. Now where would have you exited it? Probably, well, you've hit the pivot, haven't you? So you would have been front running that pivot by a couple of ticks, so you would have been out here. Or if you're following something that is a possibility I'm mentioning, you would have been out on the close of this candle here. But look at that there, as a return is good 30 odd ticks, 40 ticks I think. What have we got there? 2, 4, 6, 8, 10. That's basically yeah, about 30-40 ticks in that move there alone. Now that makes your day. Now if you got in there and you had set profit targets, you actually had a T10 down here. So you got in on your 89 bounce, and students, you know how well and how much we love our 89 bounces, and you had a T10 right here. So you would have been in again. Now if you had have entered on the T10, where would have your exit been? I would recommend, of course, you front run, have an order get out of the market just before your pivot. Either that, if you decide to stay in, just be ready to pull your stops up or to exit very, very quickly. That's what I'd recommend there. So traders, I've given you a lot of information. Let me have a quick look at my list. Now what I was going to show you is here measured moves. Now I mentioned measured moves. So a measured move, for an example, would be from there to there. If we took that maximum move, and what I'd then do is go like this. Let me just disable one of my tools here, just one moment. Okay, so if we go and take from the high to my low, this is really my first trade, and one could even argue this is my first trade in a new trend, trade one. So I go from high to the low for my first trade in a trend. I then take that and take it from my high and project that I should be coming down here. So this is my first measured move. Now if we look at this here, we actually hit this coincidentally to the T. So let me show you again what I've done. I've measured from the high to the low, drawn a trend line. I've then taken that trend line and taken that to the high, projecting where it come down. So in shorting, this is actually a T2 formation. I'm under the 34, which improves my trade quality, and that gives me a good idea of where I'm going to be. So let's apply, and let me show you the Fibonacci extension. Now in TradeStation, under Fibonacci tools, I've got price extension lines. So here's how I do it. I go from the high to the low, up to the high of that move, just there, and it projects down almost 100%. It's almost identical, you notice, traders, in doing a measured move manually with a trend line. So you can see down here, and hopefully you can see it. I know it's going to be very small, but here's the 100% level just here on this measured move. Here's my 68. Many traders use this. Now the time between this particular trade and that one, hitting the low, that's actually about 23 minutes. So you actually had the time to go and apply that the extension. So you had time to think about your trade. Now for me, and I'm going to relate back to what I do, because I don't use at this stage Fibonacci extensions, because I just had a winning trade there and I just had another one just there. Okay, so I probably achieved the same accept a bit of brokerage in trading both of those. Now what we had here was an 89 bounce, sorry, was a 200 bounce, which are not as good as your 89s or your 34s. So getting back those traders that my students that follow me, exactly what I do. I had, of course, we had a great T2 there. We would have been in and out with our 12-14 ticks there, and we had another one just here. Now hypothetically, let me throw this: if you had been trading the standard error bands, your exit would have been just above here. Now what else did we have here telling me that potentially, all right, I had a little double bottom and we had divergence here on our price, and away it went. So what have I covered? Fixed targets. I just showed you once again, which is my preferred way. Now the trailing stops, let's quickly, I haven't really shown you on the screen here. Trailing stops is you're trailing, okay, two candles behind and one tick above, so you're giving yourself some movement. Okay, so you're going down here, your stop would have been up here, down to here, your stop is up here, and you get stopped out over here. The challenge with tick-based charts and some of the faster moving charts is moving your stops. Now many traders will use, well, what about percentage? A lot of traders will use, or are taught by perhaps some of the inexperienced or the non-day traders, use a percentage of your account, etc. I think that's all hogwash. I don't think it works anywhere near as good. So let me just quickly check my little list here. I had a list here I wanted to cover. Floor pivots we've spoken about, swing highs and swing lows. Okay, let me what you will be doing, and if you just go across to my chart, and I'll just show you this, hopefully you can see here. So this is actually my trading chart, you can see here, and on the right, and sometimes I'll have it above, but I had a oil and I had the YM up, and I had the Euro Stoxx 50 on my other screens, but here I've got my anchor chart. So in using your exits, let me just go right to the end here. You may notice here on my anchor chart I've also got nowhere near as many indicators. Okay, all I've got is really on this particular anchor chart is I've got my 0 lag, my 34, the 89 and the 200, all much higher time frames. So if I look down in the lower window, that is a 200 EMA on a 3 range. Okay, so it's approximately, even though I've got a tick chart here and a range, they're very different, but just in timing I tend to find that works well for me. Now for profit targets, if I go here on this particular one, let me just show you here. Okay, I've now got a candle, and hopefully you can see that this candle is an up candle. It's a green candle. 200 EMA's up, 89, 34, my 0 lag, and I have a 3 range candle close in the direction of the trend. If we go across to here, that is this candle right here. So everything on my anchor chart is telling me what I'm in an uptrend, right? So it's good to go long. If you're using your anchor chart to confirm the direction of your trade, it's just confirmed it right there to tell me to get in. Now here, where would my logical spot be? A pivot. You can see it there, and you can see it over here. So we'd spoken about the pivots anyway. Now for me manually here, I had a trade entry here, so I had actually 1, 2 achieved almost the same thing, so you can, except I pay extra commissions. Traders, that's what suits me. But your anchor chart, you can see here, it just gives you a directional bias in the market. Now remembering I've got my 0 lag, so you can be using an 8 EMA for that as well. So I don't think there's anything I've missed here. I'm just going to have a quick look here. What haven't I covered here? I think I've just about covered. Look, for my students, you can drop me an email if there's any questions. I'll tell you what I haven't done. Sorry, I found the other list. For trendline breaks, by the way, for exits, these little black dots are your fractal points, Bill Williams, and they're available now in virtually every trading package. So you can draw your trend lines. Just got to disable something to be able to move like that. Okay, so you see black dot to black dot joining those. That's an exit signal. Now the better one is your bounce off your pivot. But what I did want to show you is the Heikin-Ashi candles. Have I got them on this one? Let me put this on hold while I get them for you. I want to show you this. Okay, so what I've just done is put my candles. Now there's a lot of different versions Heikin-Ashi out there. So we can see that, look at this, you would have been in from your, if you had have still taken your bounce off the 89, you were in all the way up to here. It's a trend following strategy. However, got you in some fantastic trends trading with the trend. You had a standard entry here, you rode it all the way up to here, you had another entry here, you exited there. That's great though when you're in a trend. Where it can be damaging or where you can get chopped up is in areas of consolidation. So they are a tool you can use, like here. Now getting back to it, and I'll finish this video, it's a long video, it's nearly an hour. There are just so many different tools you can use for your exits. So once again, students, any questions, please drop me an email, and hopefully this has answered, and hopefully I haven't left you too confused. Thank you.